Picture this for a second. You're walking down the toy aisle at your local Walmart. You're seeing the usual stuff, right? Rows of plush toys, action figures, board games, exactly like you always have. But sitting right there on the shelf, wedged between the legacy brands, is a product that has quietly achieved something absolutely revolutionary. We are talking about over 1 million physical Pudgy Penguins toys sold in Walmart stores. 1 million. And you know, that number isn't just a fun retail success story. It represents a massive, undeniable bridge being built right now between digital assets and the real physical world.
And that million-unit milestone perfectly introduces our core theme for today's explainer. We're talking about the Phygital revolution. Yeah, I know, it's a bit of a funny mashed-up word, but Phygital is exactly what it sounds like. It's a brand new product model that seamlessly combines physical items, stuff you can actually hold in your hand, with digital ownership and digital experiences that are independently verified on a blockchain. It's literally the moment when an online token steps off your computer screen and right into your living room.
So, welcome to the Explainer. Today, we are on a mission to decode exactly how the NFT market survived its infamous crash and is now genuinely thriving in 2026 by embracing true, undeniable utility. Our focus today is why Pudgy Penguins are in Walmart, the Phygital NFT revolution. We are going to cut straight through all the old hype and show you the actual, under-the-hood mechanics of where digital ownership is heading right now.
Okay, let's dive into this. Here's our roadmap for today. We'll start with NFTs in the toy aisle, see how hype fades while utility remains, and look at unlocking real-world value. Then, we'll cover reinventing brand loyalty, avoiding SEC crosshairs, and finally, wrap it all up with the soul-bound future.
All right, kicking things off with Section 1, NFTs in the toy aisle, real-world proof.
So, the Pudgy Penguin situation brilliantly illustrates exactly how you build a revenue-generating, real-world business on top of a digital foundation. Think about this. The Pudgy Penguins collection started as just 8,888 Ethereum-based digital penguins, JPEGs basically. But they didn't just stay on the blockchain. They expanded into a massive physical toy line. Now, we already mentioned the million units sold in Walmart, which is huge, but here's the absolute kicker. They have reached a staggering $1.1 billion in total digital sales, with a B. How? Because they pioneered this ingenious licensing model that directly ties the royalties of the digital token holders to the sales of those physical products. So it's a real-world physical business attached directly to a digital collection. And they certainly didn't stop there. They've expanded the brand with sub-collections, like Lil Pudgy's, and they've integrated Layer 0 cross-chain technology to broaden their entire ecosystem's reach. It's a masterclass in brand building.
Let's move on to Section 2. Hype fades, utility remains. The 2026 reality.
Now, if we honestly contrast the wild peak of 2021 with the reality of 2026, the difference is night and day. Back in 2021, you probably remember, the market was purely speculative. It was a total Wild West. We saw over 10,000 hype projects launch in just an 18-month window. And most of them, they were run by completely anonymous teams offering absolutely zero utility beyond the artwork itself. You were just hoping the next person would pay more for it. Fast forward to 2026, and the global NFT market cap has stabilized around $2.02 billion. So yes, the overall market is smaller, but it is finally built on serious, concrete fundamentals. Today's reality strictly demands verifiable, on-chain economies, heavily utility-driven models, and transparent, fully doxed founders who actually have professional track records. The retail speculators who are just looking for a quick flip, they've largely exited, and they've left behind genuine collectors, hardcore brand loyalists, and people actually looking for utility.
So what does it actually take to survive in this landscape? The harsh truth we have to acknowledge is that over 90% of those 2021 projects went to absolutely zero, finished. So look at the incredibly strict criteria required to be considered a true blue-chip collection in 2026, collections on the level of CryptoPunks or Bored Ape Yacht Club. To earn this title today, a project absolutely must have survived the bear market while maintaining meaningful trading volume post-2022. It must boast over $500 million in verified all-time sales. It also needs a highly decentralized base of over 5,000 unique holders. Why? To prove organic community health, rather than just a few big crypto whales manipulating the market behind the scenes. And most importantly, honestly, it requires a highly active development team that is actually executing and delivering on their roadmaps. No more empty promises.
Which brings us nicely to Section 3, unlocking real-world value, beyond the JPEG.
We really need to talk about how this technology has evolved, because the sheer variety of real-world utility cases functioning today is massive. Let's rapid-fire through some examples. Look at real estate. We now have digital deeds and property-backed tokens working as literal digital twins to physical homes. Or take gaming. Developers like SDLC Corp are pioneering true interoperability. That means you could theoretically buy a digital sword in one fantasy RPG and then seamlessly carry that exact same asset over into an entirely different game simply because the blockchain standardizes the ownership. It's wild. For live events, platforms like Hybrid Chain are issuing tamper-proof digital tickets. This completely eliminates fraud, allows for dynamic pricing, and automatically enforces royalties on secondary ticket sales. And in sports, platforms like Sorare use officially licensed athlete performance data for fantasy soccer gameplay. So your digital card's value actually fluctuates in real time based on how the real player performs on the actual pitch that weekend.
Now, you might be wondering, how does a physical property, like a literal house or a physical concert ticket, actually transform into a secure digital token? Well, it happens in 3 pretty seamless steps. First up is minting. This is where the physical asset's core metadata, like the GPS location of a property or the specific row and seat number for a concert, is permanently recorded on the blockchain. Second, a smart contract is deployed. Think of this like a digital vending machine. This is where the specific ownership rights, the rules, and the conditions of the asset are written directly into self-executing code. Finally, trading. Because the rules are hard-coded and the asset is mathematically verified on-chain, transactions can execute automatically and securely. This entirely removes the need for costly, slow intermediaries like brokers, escrow agents, or notaries. It just works.
Moving right along to Section 4, Reinventing Brand Loyalty, the Ownership Shift.
Okay, so the absolutely crucial point here is the fundamental shift in who actually owns the reward. We all know how a traditional loyalty program works, right? You collect your coffee shop points or your airline miles, but at the end of the day, the brand owns them. They can change the rules tomorrow, they can devalue the points, or they can just expire them out of nowhere. They offer identical, cookie-cutter rewards for everyone, and those points are locked firmly to your specific account. You can't give them to a friend. But with an NFT loyalty program, the asset is customer-owned. You hold a unique digital asset in your own personal wallet, and most importantly, it is completely transferable. If you don't want the reward or you just want to cash out, you can trade or sell it to someone else across various open platforms. It completely changes consumer engagement by giving real, actual financial agency back to you, the loyal customer.
And if you want a perfect, high-end example of this in action, look no further than Louis Vuitton's Via program and their Treasure Trunk. Instead of a generic, boring point system, they offer a highly exclusive digital key. Now, what's really unique here is that the trunk itself is non-transferable, meaning it ties directly to your specific identity as a loyal Louis Vuitton customer. But by holding this digital trunk, you unlock exclusive access to purchase highly limited, made-to-order physical products and VIP experiences that literally no one else can get. It anchors a digital token directly to highly desirable tangible perks. It's a brilliant blend of digital prestige and physical luxury.
All right, on to Section 5, Avoiding SEC Crosshairs, Navigating Regulation.
Let's look at the legal side of things. Because if we trace the SEC's timeline over the last few years, we see a very distinct shift in their enforcement strategy. Back in August 2023, the media company Impact Theory paid a $6.1 million settlement. Then, the very next month, the creators of the Stoner Cats web series paid a $1 million penalty. In both of these cases, the SEC argued the projects conducted unregistered securities offerings. However, if we jump forward to early 2025, the SEC made massive waves by officially closing their long-standing investigations into Yuga Labs, the creators behind Bored Ape Yacht Club, and the OpenSea marketplace. And they did it without taking any enforcement action whatsoever.
So what changed? Well, I'm just going to lay out the facts here neutrally because the distinction is absolutely crucial. The core difference all comes down to how the Howey test is applied to these digital assets. Generally speaking, an asset is viewed by the SEC as a security if there is an explicit investment intent. This means buyers are handing over money, fully expecting profits to derive primarily from the ongoing efforts of the creator. For instance, if a project openly markets their asset for its ROI, or explicitly ties its future financial value to a roadmap they haven't even built yet, or sets sky-high secondary royalties just to profit from trading volume, well, the SEC has historically flagged that as a security. That's essentially what happened with Impact Theory and Stoner Cats. On the flip side of this is the safe harbor of consumptive utility. If an asset's value derives primarily from its existing scarcity, its inherent artistic merit, or its immediate, usable utility, like a digital concert ticket or unique profile picture used for community status, it is generally not seen as a security. You are buying it to consume it or use it right now, not as a speculative investment in a company's future efforts.
And finally, we arrive at Section 6, the soul-bound future, digital identity.
Now here's a really profound paradox for you to think about.
The entire premise of blockchain assets up to this point has been all about secure ownership and the ability to trade freely, right? But what if an asset was designed specifically so you could never, ever cash it in? What if it was permanently, irrevocably locked to you?
Enter soul-bound tokens, or SBTs. These are non-transferable digital identity tokens. Because think about it, since standard NFTs can be bought and sold by anyone, owning one really just proves you had the money to buy it. It doesn't actually prove anything about your personal character or achievement. Soul-bound tokens completely fix this by being permanently attached to your specific wallet address. For example, a university could issue your hard-earned diploma as a soul-bound token. A medical board could issue your professional doctor's license this way. What this does is create an instantly verifiable, tamper-proof record of your actual real-world qualifications. An employer can check it instantly, with zero doubt, completely bypassing those slow, expensive third-party background check services.
The core philosophy behind this was actually mapped out in a fascinating 2022 white paper by Ethereum co-founder Vitalik Buterin and his co-authors. As they put it, the ultimate goal here is a decentralized society. A society where a network builds trust based on verifiable on-chain relationships, affiliations, and real-world achievements, rather than just financial wealth alone. It is a massive pivot. It shifts the blockchain from just being a public ledger of who has the most money to a ledger of who you actually are and what you have genuinely accomplished in your life. So, we've covered a lot of ground today. We've seen how Pudgy Penguins brilliantly brought digital IP to physical Walmart shelves. We've seen how traditional mega brands are totally reinventing customer loyalty. And we've seen how the entire market is heavily pivoting toward hard utility and verified digital identity. So, as the digital and physical worlds continue to merge closer and closer together every single day, the ultimate question you have to ask yourself is, are you ready to take true, absolute ownership of your digital identity in this new phygital era? I really hope this explainer gave you a much clearer, structured understanding of the massive tectonic shifts happening right now beneath the surface of the digital asset market. If you found this explainer or any of the other explainers on our channel helpful, please hit that like button, make sure you subscribe to Digi-Gold, and definitely drop a comment down below letting us know what complex topics in this niche you want us to cover next. Keep learning, stay focused, and we will see you in the next one.